The question that I think a lot of us need to ask is, well, what the heck am I selling when it comes to real estate investing? Because if you don't know what you're selling, all those sales skills aren't going to get you very far. So the main thing that we normally see part of the conversation about is joint ventures. And I'm going to explain what that means. A joint venture is basically a business partnership specifically for the business of real estate. So to put that in layman's terms, let's say that you as a real estate investor want to buy more property than you have available capital and borrowing power. No problem. You do a business partnership with someone who has capital and borrowing power to acquire more real estate. And I personally feel like I'm pretty qualified to speak to this topic because I have a portfolio of properties here in Edmonton of about 250 units. Just bought another 24-unit apartment building this year, well, this last 12-month period. And a lot of what I own, I've done with partners. I've actually raised close to $10 million of capital over the last 15 years. So whether it's one-to-one personal joint ventures or corporate equity syndications, got a ton of experience. And I want to share that experience with you guys so that you understand, well, what the heck is a joint venture? So I'm going to talk about that because all of us have aspirations of building a real estate investment portfolio. That's why we're here. That's what we're here to talk about. That's what we're here to learn about. But inevitably, if you are an ambitious real estate investor, you're going to hit a point where you are running out of that important resource, which is equity and or borrowing power. So let's talk about what a joint venture is, because a joint venture is basically a business partnership. So when you think about a real estate deal, think about it like a pie. And what we want that pie to be is a win-win. Now, I love a good analogy, and the pie analogy kind of works like this. Let's say that you are a world-class baker, and maybe you even have a really awesome kitchen, but you don't have the ingredients. You don't have the flour. You don't have, this looks like a pumpkin pie. You don't have pumpkin. What else goes in a pumpkin pie? Butter, cream, sugar, whatever else you need to make a pie. You don't have the ingredients. So you go out there and you find yourself a partner and you say, hey, person with ingredients, I know how to make a bunch of good pies. You've got a bunch of ingredients. Why don't we get together? Let's make a pie. And then you'll get some of the slices. I'll get some of the slices. And we'll both be able to enjoy a pie that otherwise would not have come into existence had we not cooperated and collaborated. Okay, we're not talking about pie, we're talking about real estate. So the ingredients that typically go into a real estate deal are cash, that's the money, it's a down payment, that's the startup costs, financial liability, which means the ability to get a mortgage or personally guarantee the loan, and then deal management, which typically is the bundle of things that you're trying to do as a real estate investor. So this includes, but is not limited to, finding the deal, putting the offer on the deal, analyzing the deal, structuring the deal, doing the due diligence for the deal, ongoing management of that asset as the holding period moves forward, potentially managing renovations on the property, et cetera, et cetera, et cetera. Now, this is not a hard and fast rule. This is kind of more of a rule of thumb. So know that there are a great many deals where cash and financial liability go for 50%, deal management goes for 50%. Sometimes people drop their deal management down to 30%, especially as the size of the deal gets larger. For example, I was part of a portfolio acquisition of apartment buildings that was about a $10 million acquisition. We had one partner, but they said, look, we're an easy to work with partner. We've got a ton of cash. We want to adjust the deal split a little bit. And because of the economies of scale, my partner and I were willing to take less than 30% of the deal management fee. And it worked out for everybody. So there's no right way to split a deal. This is just a general guideline. But know that the three key ingredients you typically need are cash, borrowing power, and deal management. So let's take a look at what I want to accomplish here in this presentation. I don't want to sell you the sizzle, as they say. I just want to give you guys the steak. So this isn't a sales presentation. This is a presentation meant to answer the question, what the heck is a joint venture and how does it work? And then once you get all excited about a new avenue that you can use to acquire property, well, we've got a real pro to come in to talk to you about some of the sales skills you're going to need to present an opportunity to and solidify a partnership with a potential partner. So it's a good 1-2 punch tonight. So I'm going to talk about what the deal structure looks like, what a typical timeline is for putting together a deal. We'll talk about what you as the project manager will complete. And the goal is to understand how to build a joint venture. So it all starts with a business meeting. It's a conversation. It's a sales opportunity. Now, typically, if you have someone in mind that you want to talk to about real estate, well, you want to have an exploratory conversation. There's going to be a lot of question asking. There's going to be a lot of comparing of notes. There's going to be an exploration to see if there's an alignment between you and the partner, to see if there's an opportunity to do business. What kind of questions should you ask? What should the topic of those conversations be? How do you steer that conversation? Well, stay tuned after the break, because that's Sales 101. A lot of people ask, should I start with a deal or should I start with a partner? And what does that mean? It means, should I go out there starting to find real estate properties to purchase without somebody to partner with? Or should I find a partner first and then go searching for deals? Well, I personally like to start with finding the partner first, because there's nothing more stressful than trying to build a business partnership on a 5 to 10 day timeline, which is a condition period, if you're lucky. And in today's market, you're going to be doing a lot of unconditional deal findings. So it's usually better to get the partner first. And we're going to talk about that in just a second. Advanced strategy is post-close joint venture. So you buy the property solo. Then once you have the property up and running and functioning, you bring the partner in after the fact, and they replace your own money that you invested in the deal, and then you can roll that capital forward into the next deal. So that's an advanced technique, and it's usually an easier sale because now there's a physical property that you already own that you can bring a partner into, as opposed to having to sell your partner on a hypothetical. So we just put that one in your back pocket, depending on what your strategy is going to be. But it's still building a partnership. That's what this arrow represents. So typically, the first phase of that deal is the foundation phase. That's where you're building the relationship with the partner and building alignment on what kind of deal you want to approach, as well as gaining their commitment to do business. Phase 2 is acquisition. We're going to find the property. We're going to put an offer on it. We're going to complete our due diligence. We're going to remove conditions. We're going to close. And then phase 3 is the ongoing management, whether it's a short deal where you're managing a flip or a longer term where it's a buy and hold. Either way, as the managing partner, these are your main responsibilities. So in the foundation phase, this is all the good salesy stuff. The stuff that's going to happen is JV presentation, pre-qualification, calculating ROI, usually signing a letter of intent, deposit, legal paperwork, mortgage pre-positioning, property search. Whew, that's a lot of stuff. Don't worry. Everybody who's attending this meeting, you're now on our mailing list. You're going to get a copy of the slide deck. So don't go too crazy trying to take screenshots. We'll have a recording of this. You'll be able to review it. And we want to make sure that you've got the ability to really wrap your head around this content, because I am going a bit quick. Phase 2 is acquisition. Well, this is where we make our offer. We give our deposit to the seller. Usually, if the financial liability is on your partner, you transfer the real estate offer into your partner's name, depending on your mortgage setup. That's a kind of a separate presentation, but that needs to happen. At this phase, you normally finalize your joint venture agreement. Financing is approved, conditions are removed. And then management. So typically what happens in the management phase is tenant management, paying property taxes, insurance and utilities, repairs and maintenance, banking, bookkeeping, paying out cash flow if it's a cash flowing asset, reporting to your partner on a regular basis, and then either exiting or renewing for another mortgage term. So I have a lot of content. Like I said, buckle up. We're going to get into this real quick, but all of this content will be made available after the fact, and we're going to do a quick Q&A after. So don't worry. I know it feels complicated if it's a new concept, but I just want to help familiarize everybody with what possibilities exist within the world of real estate to help you acquire more, build a bigger, better portfolio, and partner with people who want to go on your real estate journey with you. So getting started, pre-qualifying. This is the sales part. So I'm going to zip through this pretty quick, but the types of questions that you want to ask are, is your vision in alignment? What's that client's previous experience with real estate? Do they have cash available? You're not really going to go anywhere if they can't even buy a property. What are their ROI expectations, which translates into the risk? What's their timeline and exit expectations? What's their risk tolerance? I put previous experience in there twice because you really want to know what they know about real estate. And then what's their reporting expectations? Quarterly, semi-annually, annually. You got to know what's going on with your partner. From there, I like to clarify what they want to involve their day-to-day expectations, because you don't want a partner that's going to be, obsessively calling you every week to ask what's going on with the property. Chances are you don't have much of an update. Yep, the tenant's still in there, living there, paying rent. Like, I don't know what you want me to tell you here. So it's really important to make sure you manage those expectations so you don't have a little bit of a partnerzilla on your hands. Calculating ROI. How do we calculate ROI in real estate? Well, this is a combination of 4 factors. The Keyspire group calls it their 4 ways to win. Register trademark. Cool. They took a concept that's been around for 1,000 years and trademarked it. Awesome. So the 4 profit centers, ways to win, whatever you want to call it in real estate, are cash flow, which is revenue minus expense, the money that's left over when you pay all of your expenses from the rent, principal pay down on the mortgage, market equity, so the growth of the property in the market, then sweat equity, which is renovations or general developments or improvements to the property. So all of those gains of cash combined get divided by the initial investment. Projecting into the future, so you want to calculate your mortgage pay down, know your rental market growth, know the value appreciation, budget your renovation value. All these things are important. And at Mogul, we actually have a very handy cash flow and return on investment calculation toolkit that's complementary for everybody in the Mogul community. So if this sounds like a tool that you want access to help you do your projections, just reach out to marketing or one of your favorite Moguls and we'll send you the toolkit, because it is actually very, very handy. And it helps you start wrapping your head around how to analyze and project growth in a deal so that you can articulate that to your joint venture partner. Divide it by your initial investment and away you go. Now, you want to make sure you prorate for each partner's share. So if it's a 50-50 split, don't forget to divide that return on investment by 2. Nothing's going to make you look like more of a dummy than showing the total project ROI to your partner, getting them all excited. And then when you've already gone pretty deep into the process and saying, by the way, your ROI that you're going to get is half of what I've been selling you this whole time. That ain't good. So you want to make sure you're doing that right from the get-go and that you're dividing it out correctly. So how do we do the investment? Well, typically that's a combination of down payment, inspections and appraisals, legal fees, your initial reserve fund, any transportation costs. If you're like, for those of you from Vancouver and Toronto, if you're flying in to scope out your Edmonton property, or if you're from Edmonton and going to scope out a pre-sale or whatever, you want to add that into the mix. Well, this is fun. Let's use the back arrow here. Of course. So that's your investment. Now, one of the main principles of a joint venture is treat it like a 3-legged race. You're either winning like these kids on the left, or you're losing together like these kids in the middle, or you're just having a good time like the kids on the right. Either way, it's a win-win. So what does that mean? You're splitting profits. It's a 50-50 split, or whatever your deal split is, of the profits. So in order for you to win as a managing partner, you have to create profit for the whole deal and therefore create profit for the investor. One feature that I think will give you a competitive advantage in the marketplace is you also build in a lose-lose clause. So you commit to your partner that if the deal goes down in value, you also share in the loss. Not mandatory. A lot of people won't be willing to do that. But if you're participating in a lot of investment groups and you're pitching investors who have a lot of different choices of who to partner with, a lose-lose shows a lot of integrity, and it will set you apart from other investors who aren't offering that security to the investor. Now, in phase 1, you want to sign a letter of intent. Why do we want to do this? Well, a letter of intent is not a legally binding joint venture agreement, but it basically puts down in paper everything that you're setting out to do. So the kind of stuff you want to put in a letter of intent would be, how much cash and mortgage and who's investing it, what property you're planning on selecting, what the deal split is going to look like, how you're going to manage cash flow, who's going to do the ongoing management, what your timeline and exit is, how the banking is going to get handled. And I would also suggest getting a deposit from your partner that you can then use as the deposit on the property you put an offer on. Why? Because you're going to do a heck of a lot of work to put a deal together. So the letter of intent comes from the partner first strategy. And you want to see commitment from that partner, because you're going to have a real rough time if you start going out putting offers on properties. You bring those offers back to your partner and they're like, yeah, I don't know if I'm actually ready to do business. You don't really want to go to the next phase of building a joint venture and start sourcing properties until you actually know you have a serious partner that wants to do business with you. So yes, it can feel a little bit intimidating asking someone to sign a letter of intent and asking them for a deposit. But I can tell you, the nervous energy and excitement you're going to bring into asking them that is a much better proposition than the disappointment and foolishness you're going to feel once you go all the way through putting an offer in with your realtor, only to have to go tell them, oh, but my partner doesn't actually want to do the deal and they're not that serious and I'm sorry. And now I'm not on your A list and now this realtor isn't going to send me their best deals anymore. You want to be that guy? No, go get a letter of intent. Next, mortgage pre-positioning. You don't want your mortgage broker to look like this and bring you a deal that you can't even close on. Give me a break. They don't like that. So make sure you have a conversation with your partner and the mortgage broker before you go out putting offers on properties to make sure you know your budget and you know you can get approved really quick, especially in this market where unconditional may be part of the gig. If you're not prepped and ready to pull the trigger on a property, you're not going to get to see the best deals. And you're going to tick off your mortgage broker. And again, you're going to work now you're going to be on your realtor's B list and your mortgage broker's B list. And your joint venture partner is going to be like, well, this person is not as organized, intelligent, or professional as I thought. And they'll start second guessing doing business with you. All of those are bad things. Make sure you get your pre-position in place. JV document. So a typical joint venture document from my experience is about a 20 to 25 pager. If you want a template of a unlocked, editable Word joint venture agreement that you can use to build off of, let me know. That's one of the things we've got available for our Mogul family and for Mogul clients. And the types of things it should include is basically everything that was included in your letter of intent will then get translated into legalese. It should have contingencies if partners default or pass away or are incapable or don't fulfill their duties. Emergency exit procedures. Wait a minute. What if someone has to exit the deal before the end of the term? What do you do? There's the old phrase, good fences make good neighbors. Or as my good friend Kanye says, if you ain't no chump, holler, we want prenup. Yeah, it's something that you need to have, because if you don't have a joint venture agreement in place, you will have a very miserable time if people's expectations are not in alignment, or if you go to exit the deal and something as simple as the split of the profit isn't clearly defined. So that JV document is essential because it creates the framework in which you're doing business and keeps everybody on the same page. Quite literally the same page of paper upon which these words are written. That's going to make sure that your deal goes smoothly. And the joint venture document is a major, major deal milestone. One thing that I can tell you is that lawyers sync deals more than any other part of the entire joint venture process. You can present to somebody, get them all hyped up about buying a piece of real estate property. You get them, you sign a letter of intent, you take a deposit, and then they take your 25-page legal document to their lawyer, and the lawyer wants to justify billing this person $500 an hour and picks your joint venture agreement apart, criticizes the heck out of it, and scares the crap out of your potential partner. And boom, all of these worries, concerns, and otherwise issues sink the deal. So that's why in my order of operations, reviewing the joint venture document happens before even putting in an offer, so that you have agreement on the joint venture document, everybody agrees on the terms and conditions, and you're ready to sign. You do not want the lawyer sinking the deal when you've already got a pending offer in place. People don't like making decisions under duress, under a time stress, or under pressure. So you want to make sure you review that joint venture agreement before the pressure of doing the transaction is on the table. Once you got that all good to go, you do the property search, pretty self-explanatory. We're all real estate investors. We know what that looks like. And then boom, we write the offer. So if you're writing an offer, alert your partner, ensure that they are 100% ready to close, reconfirm that, use the deposit from the letter of intent for the deposit on the real estate, And then make sure you add the have buyer and or nominee clause so that if you have to assign the contract to your partner's name to close, you've got that in there. Now, if this all sounds a little complicated, guess what? That's what the Mogul team is here for. That's why we exist. We work with investors all the time. We know how to build a bulletproof contract that's specially crafted for joint venture deals. So don't worry, we got you covered. Phase 2 is due diligence. This is where you sign the joint venture contract with the lawyers. It's swirling around because it's so important because we don't want the deal to sink. Once the JV agreement is signed, then we transfer the offer to the final buyer's name, which could be the partner. Finalize your financing, finalize the management team, set up the bank account, put the reserve fund in, do your due diligence, inspections, etc. Get contractor quotes if it's like a BRRRR/flip to yourself deal. And then we remove conditions, and we're as stoked as Connor McDavid scoring a goal. And that is when things get really exciting. We did it. We earned ourselves an opportunity. We built a relationship with a joint venture partner. We selected a property. We put an offer on it, and we removed conditions. Now, here's the funny part. After all that crazy hard work, now the real work begins, because you're going to do all of the actual execution of this deal. You're either going to manage development and or renovation, or you're going to do ongoing management of a property that you're going to hold for an extended period of time. So congratulations, you've earned the opportunity to do more work. But guess what? That work has a reward, which is the benefits of owning property. So obviously, I'm being a little bit facetious because that's why we're so darn excited. We're about to make some money. We're about to increase our personal net worth, and we're about to build a better position for ourselves and our family, which is why real estate is so powerful. It's very exciting stuff. So property management, maintaining a relationship with the property manager, or if you have volunteered to be the property manager, making that happen. Keep the rent current, make sure you have a vacancy plan that you're executing, manage the cash. You're doing the bookkeeping, managing the bank account, managing and distributing cash flow. This is all part of managing partner stuff. Fixed expenses, make sure the taxes are getting paid, insurance is getting paid, condo fees are getting paid. Again, this is not rocket science, but this is your responsibility as the managing partner of a deal, as the person who has set up the joint venture. Repairs and maintenance, plan for upcoming capital costs, complete initial repairs if needed, oversee the contractors, make judgment calls, on unnecessary. And I personally, to this day, physically visit every single property. That's a lot of properties that I own every single year and just do a quick walk around. Nobody is going to care about your assets more than you. So go check them out once in a while. You'll notice things that need addressing, and you can proactively fix problems before they explode into really expensive problems. Reporting, how often does your partner want to be reported to? I have partners, typically I do an annual report, but earlier on, I had partners that were a little more hands-on. They wanted quarterly reports. Typically, annual is okay. What content do they want in that report? Do they just want an annual financial summary? Do they expect photos? Do they expect a written summary of what's going on? Make sure you're on the same page. And so these are just some ideas of things that you can put in your annual report. And then finally, we get to the most exciting part, which is exit. Are we selling and cashing out? Are we refinancing and holding? Are we going to refinance and use that capital for future acquisitions? You should be talking about this at the beginning so that you have it planned out for when it actually happens. If you exit, boom, we're making it rain. That's why we did all this work in the first place. We split our profits. We give each other a pat on the back. We have a little high five and everybody feels great. And that is the basics of how a joint venture works. So we'll open it up to some questions. Let's put them in the chat so that I can read them. But if anybody wants to blurt out a question, that's A-OK too. I see a bunch of people requesting the template. Thanks, Corey. I always appreciate the positive feedback. Makes me feel good about myself. So I will open it up for questions for a minute. And if you're the kind of person that needs to absorb all that information and watch the presentation again, reach out. That's what I'm here for. I'm here to help you guys learn more about doing deals and creating business opportunities in the real estate world. So thank you guys for tuning into that. We're going to head into, I'm not seeing a lot of questions come in, which is all good, but does a JV agreement need to be signed with a lawyer? It is more it is easier to, all right, now the questions are coming in. Okay, does a JV agreement need to be signed with a lawyer? If a lawyer is the witness to the signatures, it adds a lot of heft to the enforceability of that document. So the answer is technically no. A legally binding contract can still exist without a lawyer present, but it makes the contract a lot stronger if push comes to shove if a lawyer is signed. What's the best way to locate an investor for your JV project? Well, that is what we call foreshadowing, because our keynote speaker will be answering that very question, giving us sales strategies, tips, and tricks for real estate investors. If a PM company is hired, will the working partner still keep 30%? Absolutely. I typically analyze every deal as if a property manager is in place. The distinction is project management, or what some people also call asset management, versus property management. That would be like saying, hey, should I still get 30% if we hire a realtor to find us the deal? Well, yes. As the person who is doing the project and or asset management, you have a team of experts in place who help you bring the project together. And one of the people on that project should be your property manager. In fact, there's a very strong argument to be made that if you are doing the property management on the project, then the project should be paying you 10% in addition to the split for doing that role. But again, if you're trying to stay competitive, or if it's your first deal and you're just trying to sweeten the pot for a wary investor, maybe you include that as a freebie on your first couple of deals until you build your confidence. Mogul is okay. Well, those look like our questions. So we are going to head into our networking break. Ask yourself the question and be intentional about who do you want to meet? We've got different breakout rooms with different topics. So before you select a specific breakout room, think about what your intention was for this event. I'm hoping that your intention was this is more entertaining than Netflix. I hope your intention was to actually learn something and build connections. So learning something, check. Now, in terms of building your network, that's where you find opportunities. That's where you're going to find maybe your next deal, your next partner, or just an idea that's going to help you along your way. So pick the right networking breakout room for you. We're going to network for 5 to 10, and then you'll see the countdown. We'll head back into session, and then the real juice really starts flowing, because we're going to talk about, well, this joint venture idea is cool and all, but how the heck do I get a partner? Somebody just asked that. We're going to answer it and more. We're going to talk about how to actually close the deal once you have potential partners in place. So you do not want to miss our keynote presentation. It's going to be spectacular. And with that, I will bid you adieu for now, and we'll see you in a breakout networking room. Thanks, everybody.